Today, I'm going to show you if I had to start from scratch and create a portfolio right now, what I would be buying. Basically, it's going to be broken into 3 to 4 categories: stable companies that are undervalued, some mid cap stocks with higher risk, international stocks, and then, a couple alternative assets to help us offset on these market downturns. All right, so the first category and your most heavily allocated, in my opinion, should be stable and undervalued companies. These are companies with big names. Most of you likely have heard several of them. If you haven't heard of them, I'm sure you probably use some of their services and products. And in my opinion, a lot of these names right now that I'm going to mention are trading at a really strong discount. It makes me think of a Warren Buffett quote, is what we're trying to do here. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. All right, so my first stable and undervalued company on the list is Amazon, ticker AMZN. And as you can see in the chart to here, this is everything the company owns. I mean, I don't know about you guys, but my wife is buying packages to the door every day. I mean, Amazon, there are articles coming out about robotics, about how much they're going to fire the work staff, air drone deliveries, robots driving cars, robots doing packages, little Roomba-like vacuum shooting across the factory floor. I mean, this company is a borderline monopoly, in my opinion, going to be around for a while. And it just absolutely baffles me if you pull up their chart on the last 5 years and take a look at their performance. I mean, we'll get into it in the next slide, but it is at a very attractive price to buy right now. And the fundamentals have not changed. They're still generating revenue, they're still profitable, and they're actually coming to take the number one spot from Walmart in the highest revenue generating company in the United States. Any way you want to chop it, slice it, the company's trading at its cheapest valuations, any metric you look at, going back to 2016 to current. I mean, looking at EV to EBITDA, look at price to earnings, look at price to operating cash flow. They're all at their lowest point in years, yet the company's fundamentals have never been stronger and future prospects have never been brighter. So Brookfield, ticker BN's a global investment company that owns and operates a pretty large portfolio of critical infrastructure, real estate, and a bunch of other assets. A good play for AI too. Basically, they're the Canadian Warren Buffett over there. Okay, that's what you're betting on with Brookfield. When they set a target, they hit it, and actually they go above and beyond it. Now, I have 5 stocks here, and I'm sure you've all heard of every single one of these. The S&P 500, Walmart, Berkshire Hathaway, that's Mr. Warren Buffett, Louis Vuitton Moet Hennessy. I'm sure you've consumed one of those brands. Amazon speaks for itself. And Brookfield, ticker BN. I mean, look at these companies. It's performing alongside and destroying over the long term. Incrementally, look at the 20 years, 16% return, 25 years, 19% return. You get to that 30-year mark, and they're making 4% more over time. With over a 30-year chart, you're getting a 14,000% price outperformance here. I mean, and the company has a very strong history of meeting its expectations. And you can look into past shareholder reports and see their price targets and how they've met it and the returns they've given to shareholders. And they made another bold claim here saying by 2030, the stock's going to more than double from $102 to $210. All right, next up on the list here is United Healthcare Group. I'm sure all of you guys have heard of it. They are the largest healthcare company in the world. And recently, the company has seen some scandals going in. There have been DOJ investigations into the company, but stock price has taken a very hard ding here, hitting on nearly 220 in 2025 here earlier this year before it rebounded. And there's been a lot of insider buying and a lot of buying from prominent names, investors. Warren Buffett even opened up a multi-billion dollar position. This is another great name to add to your portfolio. I mean, I think it's the third or fourth largest company in terms of revenue in the United States, and they're not going anywhere anytime soon. The next name on the list here is Novo Nordisk, and basically they're one of the largest pharmaceutical companies in the world. They have 84% gross margins, 36% profit margins, almost a 30% return on invested capital. They grow their earnings per share by like 8% plus a year, and they have a 3% dividend. I mean, the company's beautiful, and it's been a victim lately from comments from President Trump on GLP-1 pricing. There have been Medicare pricing negotiations and just overall increased competitions in the market from companies like HIMSS. All right, the next name on the list here is Nvidia. It still looks cheap on a PEG ratio, and they grow so much, that's really why. It still trades at a cheaper multiple than Walmart and Costco, so I don't think the top's in on the stock there, but their GPUs are the preferred hardware for training and running complex AI models. And if you know the CEO, Jensen Huang, I mean, he's the man. He's enough of a reason. Sometimes you just see these visionaries that you fall in love with. Jensen Huang's the man. This is one of those names that you probably see and are like, what the heck is this one? But remember how I said earlier, you're going to say a name that you probably don't know, but you use their service. Have you ever traded stocks before and bought something on the New York Stock Exchange? Well, that's who Intercontinental Exchange owns, and a bunch of other little exchanges and several clearing houses. But in my opinion, it's trading at a good discount in the time to buy right now. So remember how I said there's going to be one of these names on the list here that you don't know, but I bet you use their service. So if you ever bought a stock before on the New York Stock Exchange, one of those listed tickers, you paid ICE. ICE is the Intercontinental Exchange, and they own a portfolio of global exchanges, including most prominently the New York Stock Exchange and several central clearing houses. The stock's trading at a really good discount considering they have a borderline monopoly with the New York Stock Exchange. I mean, it's an incredible moat. The stock hardly ever dips, so when it does, I buy up every time. All right, so next up on the list here is S&P Global, ticker SPGI. I mean, this is very, very prominent company in the finance world, and what I mean by that is they have access and databases to a plethora of information from bond ratings to financial data sets to ratios at an industry level. I mean, it is an invaluable company that has another borderline moat around financial data. And if you've ever worked at a financial firm, accounting firm, I'm sure you've heard of this, and it's a great time to buy. Whenever that stock takes a little dip, as you see, very few dips in this chart, that always comes back up. So, I'm buying anytime the stock goes down. Now's the part of the video where we got out of the bigger cap names that are undervalued, and I want to start moving more towards the sub $10 billion range. These stocks have grown and show promise, but at the size that are at, there's still significant risk, and these should be weighed lower, lower weight in your relative portfolio. But let's hop right into it. All right, number one on my list here is Shift 4. Shift 4 is basically a payment platform. It was built on one simple idea here: own the whole entire checkout experience and take a small fee from every transaction that runs through its little ecosystem here. By combining payments with software and hardware and data tools, it earns about a 50% EBITDA margin and keeps growing as more and more merchants join. We're still in the very early stages here of a global shift where payments and softwares are converging, and especially overseas where the legacy process still dominates. An all in one payment platform leading the industry's transition to the cloud is essentially Shift4's mission. And even at those new Tesla diners, that's who Elon Musk has picked to run their hardware, software, data tools as Shift4. I mean, if it's good enough for Elon, it's good enough for me. And the company reports Q3 earnings relatively soon, but just taking a step back and looking at Q2 earnings, you can see some of their recent highlights here. 25% increase in volume year over year, 26% increase of gross profit, 29% increase in sales, $41 million in net income on the quarter, and a 26% year over year increase in adjusted EBITDA. Next up on the list here is Lemonade, and Lemonade's a US based insurance company which caters to homeowners, renters, pet insurance, life insurance, car insurance, and it's all done through their artificial intelligence platform, which is extremely helpful in detecting patterns and allowing the company to have better risk management than traditional insurance companies with their use of AI, and everything being digital allows for applications to be approved in seconds from your phone. And I have some of the key metrics laid out for you here for the company's most recent performance. You can see their in-force premiums up 29%, premium per customer up 4%, total customers up 24%. And you can see in the chart down there that their adjusted EBITDA keeps crinkling up forward, hoping to finally break even soon enough. All right, the next name on the list here is Harrow, ticker HROW. And Harrow's disrupting US eye care by operating one of the largest portfolios of eye medicine drugs. It leads products like Vivi for dry eye disease and has been going rapidly and is expected to continue this momentum. I mean, this is a really interesting name in the sense that I don't know if I can find another stock that's projected to grow EBITDA above 70% for the next 3 years and trading below a 17 times EBITDA multiple. I mean, it's a great deal right now if they can continue to execute. All right, that's all I have for some of the more riskier small cap names. But now I want to hop into international names because I think it's important to kind of have your core portfolio, like we said, in the undervalued US names and in some high growth potential mid cap stocks. But I think it's very important, right? Because when the market starts to pull down the US market, it's important to have these alternative assets and international names because sometimes there's different things going on in different countries. There may be a problem in the U.S., but China could be booming, but Asia could be booming. So it's all different. And then also, you have the currency translations. If the dollar weakens, foreigners are going to have more purchasing power in U.S. dollars. So it's a cycle that revolves around, and it's a nice hedge in your portfolio to have and give you some nice diversity. All right, so the first international name here is MercadoLibre, ticker MELI, and they're a leading e-commerce and fintech company in Latin America. They operate an online marketplace, a payments platform, and they offer related services like logistics, credit, and advertising. They're basically like Amazon in Latin America with even more diversified service offerings. And just to point out this chart, I think it's important to take note. This blue squiggly line at the bottom is the market cap, right? How much the company's worth over time. And you can see it staying flat basically, while, two other important metrics like total revenue and cash generated from operations are on a continue upward incline. It's interesting because, in my eyes, you would imagine the stock price appreciates as revenue increases and the company becomes more profitable. It's not the case with MELI, which I think offers a nice buying opportunity for us right now. All right, next on the list here is Alibaba, ticker BABA, and they're a Chinese multinational technology company that provides e-commerce, retail, and cloud computing services. Chinese companies recently have seen a serious rebound in stock prices, and with tensions rising between China and the US, Alibaba could see some more business heading its way. All right, so the next ticker on the list here is Grab. It's a super app in Southeast Asia that provides a wide range of services like ride hailing, food and grocery delivery, and even digital services for loans and payments. It's very prominent in Southeast Asia, and I believe it's here to stay and is a good time to buy because there's not a lot of hype on the stock, particularly. And with the final name on the list here is New Bank, ticker NU. Basically, it's a digital bank and it has been overtaking Latin America. And they just filed to have a bank chartered in the United States soon. So you may even become familiar with this name. But they have been eating the big boys' lunch all over in Latin America. I mean, you should look into the growth and the customer satisfaction of the clients to New Bank. It's something to behold for sure. And I just wanted to show you some quick highlights because New Bank's been ridiculous, only on a tear. 123 million new customers as of Q2 2025, 83% activity rate, 85% annualized growth rate since 2021, 3.7 billion in quarterly revenue. 80 cents monthly cost per customer, 40% year over year growth, and 122 million people financially impacted and touched by Nubank. All right, and for my last category of assets here, I'm going to talk about alternative assets. These are assets that traditionally have a beta that does not follow the stock market. Beta is basically a fancy term for correlation with the stock market, right? When all the stocks go up, usually gold and crypto aren't going up or have an inverse correlation with it, especially during a recession when stocks fall, gold rises. All right, so the first alternative asset that I think is good to have in your portfolio is Bitcoin. Although I will say, if you run some recent regressions in the last couple of years, Bitcoin's beta has started to slowly follow that of the stock market. So you're not really getting those uncorrelated returns, but it's still a nice asset to include in your portfolio that isn't really dependent on the cash flows of a company, but rather the inherent intrinsic value of Bitcoin. And the last name here on the list, and as the last alternative asset, is gold. I mean, gold has been around since the time before Jesus. They paid in silver and gold to kill Jesus. So it's not going anywhere soon. It's been around for thousands and thousands and thousands of years. And this truly does have a beta that is opposite to the market, meaning when the market goes down, gold spikes. When the market goes up, gold doesn't tend to rise with it. But interestingly enough, gold has seen an amazing year. I mean, pushing from I think about 2,100 to about 3,000 plus dollars now for an ounce of gold. It's always good to keep in your portfolio, and you can also target it through miners. So that's all I got for you guys. As always, this isn't financial advice. Always consult a professional and let me know what you think about the starter portfolio I'm helping you guys create. And if there's anything you want to buy or something you do like to buy, let me know. Hope you learned something.